Hey guys, my name's Max. Thanks for tuning into the channel. Really appreciate you guys being here today. Have a good video today. I've been a big proponent of high yield covered call funds, and especially explaining the way they work, how they work and how they don't work, and some of the advantages and disadvantages. Well, yesterday I saw a really good video from kind of a mainstream Wall Street guy. He's an option guy. He's been on CNBC a bunch. His name's Mike Khouws, and he was initially a little bit on the critical side of some of these high yield funds. Well, today I want to go back and I want to look at what he said about a year and a half ago and some of the other CNBC hosts. But then I want to also at the same time kind of talk about what we've learned in the last year and a half and see, and then we might look at a few comparisons and see if it's, borne out to be the truth. And then from there, we're going to go look at the video from today. And Mike has changed his opinion quite a bit. There's another guy on the video that's kind of a Bitcoin guy, and that is into Misty. But I'm mainly concentrating on Mike. I want to focus on the option aspect of it more so than the Bitcoin aspect of it. The Bitcoin stuff is interesting to me, and this Bitcoin guy is interesting for sure. All right, so let's get into the middle of it. I'm going to show you the first clip here from Mike, and this was back in the Wayback Machine from about a year and a half ago, and I reviewed this video. It was one of the very first videos I did, and I reviewed this video. So let's go watch it real quick, then we'll talk about it.
The catch, as always, if you are selling put options, you're selling a form of insurance on the market. So if volatility spikes, you are going to have some risk there. There's something else, too, which I think is kind of important to think about, which is when you sell very short-dated options, you're subject to what we call path dependency, which is how the market behaves from one day to the next. If I sell an option that expires in 1 month and the market ends up at or above that strike, I'm going to make my money. However, if I start selling at-the-money options every day, I can actually dig myself a hole that I need to then dig my way back out of. So even if the market ends up higher, if it took a really bumpy ride to get there, this might not work out.
What's your take, Dan, on a product like this?
It sounds like an accident waiting to happen. So you introduce these in a very low vol period. We have a VIX that's, just below 13 here. Mike's talking about taking a quarter of a point by selling at the money puts. If there's some sort of event, right, and there's a number of these sorts of funds that are doing these sorts of things, and it's not just ETFs, right? There's a lot of people employing these sorts of strategies, and we haven't really been able to put our finger on what these 0 days to expiration, what they've meant. I think a lot of people smarter than us, probably Mike Khouws is definitely smarter than me. They said it's been vol dampening, but if there's ever a reason for volatility to come back into the market, I don't know how these things are going to perform.
Well, the expression is picking up nickels in front of a steamroller. Mm-hmm. The risk reward on it, I don't think makes a lot of sense. I get that short dated options. So not just single day and these OTs, but 5 days or less, or half the option volume of the markets these days. And that makes sense to me, especially given, event risk and people that are trading and really a lot of traders don't want to go home with any exposure every night, and they flatten it out. So that makes sense. But again, collecting premium and when you have a chance to really have downsized losses, not trades I want to be part of.
You're not getting paid enough to take that, in my opinion. The market is not paying you enough to take the type of risk that you're putting on. You probably don't even realize that you have.
You could see these guys weren't very complimentary of it, of high yield. And they made a good point. They say, we don't know how this will do in it's a low vol environment. Wonder if all blows up. Well, this is a year and a half later, so we do know. So let's go back and see if they were, if they were right or not. So unfortunately, we had a very high volatility print. It was either the fourth or fifth highest in history. And it was just a few days ago. Now let's look at how the high yield fund did compared to its parent over this course of time. So the low in the market was made April 7th. So let's look from the start. Let's look from the start of the year. We'll look from the start of the year till the low. Okay, so here we have the QQQY, the high yield fund, which is the one they were talking about at the time in that video. They were talking about Defiance, and the only two that were out were Triple QY and the SPY based one. It was called JEPY at the time. All right. So you can see here, we have had a really bad volatility situation. So we can't say we haven't had one now. This is the fourth worst volatility explosion in the history of since they've started trading the volatility index. Either the fourth or the fifth. You can see the yield fund was down 12.28%, whereas the high yield fund was down 16%. You know, it's about a 25% difference. So it's, you know, now that, of course, the other thing is we know that these funds create a buffer. So they do a little bit on the way down. You guys who watch my station understand that. But we also know the buffer kind of hurts you on the way up. Well, let's see how this is done to date, how the fund is done to date. In other words, let's see how fast it's recovered or not recovered. Sure enough, the market has recovered a little bit faster than the fund, just like we would expect, but the fund had a little bit of downside buffer. Anyway, so those guys, you know, the picking up pennies in front of the steamroller, I wouldn't call what Defiance does picking up pennies in front of a steamroller, but it's up to you. So since inception, it has returned 5% total return, whereas the indexes have returned 20%. All right. The difference is, though, QQI, the high yield fund, has paid $41 in dividends on something that cost you $60 initially. All right. Where the other one, the non-high yield fund, pays you $5 on something that costs $377. Bigger dividend creates a buffer. The buffer helps you on the way down, which we showed. The buffer hurts you on the way up. Now we're going to go to some video from today, or from yesterday, actually. And we're going to see what the same guy is saying now. Listen to this.
So, yeah, John Anderson says, excellent work, Misty Long, a simple way to get extra money. Yeah, yes. I mean, look, as I said before, it's long MicroStrategy. If MicroStrategy gets hit hard, this will get kicked in the teeth, make no mistake. But the difference is that you are, of course, getting cash distributions over the course of time, and that reduces its risk because it's a lower delta, lower duration way to play. So unless, of course, you reinvest your dividends, in which case it's not lower duration, but you get my point.
Okay, so that's my first clip. I think he's beginning to get it.
Looking at this thing, and they're saying, okay, this and any similar instrument where you see big dividends being paid, and there's this issue about the net asset value essentially being distributed. The price of Misty's down 80%, but the total returns, if you had simply taken the dividends and put them into treasuries, is 90% to the good. And if you'd reinvested it in the equity, 146 or 147% to the good. So they're clearly not just taking your money and returning it to you, because how could they just simply take your money, return it to you, reinvest it, and make it 2.5x what it was a year earlier? You can't.
I know we all understand that, but it's good to hear from the mainstream Wall Street that they're finally catching on. This is actually real money that these funds are earning.
Obviously, that would be. It's like the Three Stooges when they're paying each other. Oh, I owe you $20. I owe you 20, and and they all end up, satisfying each other's debt. Yeah, so it's not. They're not just passing the same $20 back and forth. There's actually real volatility risk premium being captured here.
Amen. Did you guys hear that? There's actually real volatility risk premium being captured. That's all we want. That's all I want. Very good. Let's listen to two more comments that he made, and then I'll sum this up.
Okay. So what this chart represents, and hopefully you guys can make this out, this is a regression of MicroStrategy to Misty. So this is the log returns versus the log total returns of Misty. Why the log total returns of Misty? Because MicroStrategy doesn't pay a dividend and Misty pays a big one. So if you try to, for anybody who's going to try to do this at home, you got to look at the total returns, because if you're only looking at the price of Misty without incorporating the dividends, you're going to get these wild days when it trades X. So basically, the last dividend was, I can't remember, it was like 13% of the value of Misty at the time that it was paid. So you're going to get these really wonky kind of results. So you got to make sure that you're looking at the total returns. What you get, and what you can see is that if you own Misty, you have a huge exposure to MicroStrategy. Okay, so let's be very clear about that. Is it the same as owning MicroStrategy exactly? No. It has lower volatility. It's about 15% lower volatility owning Misty. And that makes some sense because if you're selling premium, you're selling a lot of premium, two things are happening that compress the volatility of what you hold relative to the underlying asset. One is the premium you're collecting. So if you're receiving regular cash distributions over time, just like if you have a bond that pays quarterly coupons, it's going to have lower volatility than a similar maturity bond that is a zero. That is to say, a bond that pays you nothing until the end, right? So if you're receiving regular cash distributions, the volatility of the asset is going to be lower. The other is that you're selling off the upside, right? You're owning MicroStrategy and you're selling upside calls. So that means that your exposure on the upside is going to be capped. And if you look closely at this chart, you can kind of see that here. You'll see that there's a couple data points over here that they're not tracking the line as closely, and that's because
now Mike doesn't understand this, but those data points where they weren't tracking the line was before the strategy change. And in fact, the data points that have since they've been tracking the line are right on it. And not only that, on big up days, we even have some convexity. Look how the linear regression tells up at the end. And he's getting ready to talk about that, but he doesn't realize that problem's been taken care of.
Misty is short calls in MicroStrategy as MicroStrategy goes up. But what's funny, I actually created a fourth order polynomial to sort of follow this track, is that it tails slightly to the upside. And Scott, when you spoke to Scott Snyder, the head trader, and to Michael Venuto, they explained why it actually starts to come back. Your returns actually start to come back on the upside. So the characteristics of Misty's performance returns might change because of lower volatility, but they're changing their strategy, aren't they? What are they doing differently now?
Yeah, so they've adapted to slightly lower volatility. As volatilities come in, they began to add vertical call spreads. So they're selling verticals, thus giving them some upside kicker, right? So as the way their perspective on the Misty trade is they have a target income that they're trying to bring in every month to make their dividend, right?
How much is that?
I'm not exactly sure. I guess 8%, somewhere in that range.
The answer is whatever the IV is what their target is.
But I'm not. Don't quote me on that.
Mm-hmm.
So once they've achieved their target, they can go ahead and sell verticals and give themselves exposure to an upside rip in MicroStrategy. And they've begun to do that as those upside calls have come down in value, right? It's also forced them to move closer to the money. So when they're going to sell a vertical, right, instead of, let's just put MicroStrategy or strategy at 400, instead of selling the 410 call, maybe now they're selling the 405 or the 400 call and buying the 430 or the 425, right, to give them exposure to the upside move. So it's very interesting. Look, these are very smart people, right? Scott, as I mentioned earlier, he's creme de la creme of options traders. They understand this game. They get it, and they have a goal. They have a mission.
You're gosh darn right. They understand this game and they get it. It was a good video, and I feel like we finally come mainstream. We're finally out in the open. This other guy is a good follow on Twitter, and he's a Bitcoin maximalist. And he had a Spaces in Twitter that Mike Venuto was on. I don't know if Jay was on it, but the head trader was on it. Venuto was on it, and there was like 80,000 people there. It was a huge success. The Bitcoin community really loves this. So this is the Bitcoin community getting together with the option community. Just to review real quick, we've learned there's no free money. You've heard him say that several times before. So ETFs, covered call ETFs, They have different factors. They can go out of the money, they can go in the money. They can do call spreads. They can do just calls. They can do all kinds of different things. We aren't going to get into that. But the things they do can either enhance the yield of the high yield fund, or it can enhance the potential for NAV return, the strategy. It can't do both. For instance, selling at the money options enhances yield, and selling out of the money options enhances potential upside capture. High yield equals low return and vice versa generally. Higher yielding funds do better in down markets. Lower yielding funds do better in up markets generally. And that's because there's no free money. The market's efficient. There's probably a perfect fund out there that has that's selling options, the perfect amount out of the money where they have enough income, but they also have enough upside. It probably exists. I don't know where it's at, and I don't think it's that important to have the perfect fund. I'm trying to make a portfolio made up of several funds that together will give me the risk and reward I need, will give me the potential for upside, but also the income that I require. And that you've seen my model portfolio. We talk about that on a daily basis. And every time I put a new position into that, I tell you guys about it. But those are the facts of life as far as high yield ETFs go. They aren't Ponzi schemes. They aren't going to zero. They aren't leveraged. They're high powered would be a better word, but they do not use leverage. I can assure you they do not use leverage. They could sell all those T-bills and they could do the same thing they're doing now, but 3 or 4 times the size using leverage. So that means instead of making 50% like they're making now, they can make 200% in theory using leverage. They do not use leverage. I can assure you that. All right, guys. Well, I hope you like this video. I really enjoyed just the fact that the Bitcoin community is coming together with the option community. It's great partnership, and we're glad to have them on board. And Misty's an incredible ETF. There's no doubt about it. All right, guys. Take care. Have a good day.